So that was ugly. Netflix investors woke up this morning to the stock down 29% at the open after back-to-back tragic quarters. And there was no bounce either, as the stock finished the day down 35%. Since peaking in November at around $692 a share, the stock is down 68%, all while still getting pumped up by all the crazies out there. The street has been surprisingly positive on Netflix, but couldn't turn its back again on this one, as target price is tanked, but still sits at a premium of 56% above the current share price. So what the heck happened? Well, on the face of it didn't look too horrible. Revs were still up, and yeah, they did miss the street's target, but it wasn't typically what you'd think would cause a 40% price correction. And heck, EPS actually beat. So what's up? Why did the thing sink like a stone? Well, there's two main reasons for that. Firstly, the company posted its first decline in subscribers ever. And secondly, the guidance was soft, like 10-ply soft. So let's break that down a bit. After a nice pickup at the start of the pandemic, from people spending a lot more time on the couch, things have really begun to wane lately. This quarter was just the icing on the cake, and as like I said, forget about the growth story, this company is actually losing subscribers. The tally for net additions came in at negative 0.2 million. Now, if we're being totally fair, the company did state on the call that they lost 0.7 million subscribers from Russia, so adjusting for that, it's not technically a decline. But still, it's a far cry from the 2.5 plus million new subscribers they guided towards last quarter, or the 2.7 million the street had forecasted. Next up, the guidance was none too pretty either. The company is guiding towards a revenue of $8.05 billion for Q2, which is a country mile off where the street was. Heck, it's actually below the entire analyst range, which takes a little bit of effort to do. Next, EPS was in the ballpark, but likely there's some funny stuff going on there given the revenue guide. Likely some non-operating strings being pulled, like a beat on tax or something. And the company is expecting another quarter-over-quarter decline in subscribers, versus the street numbers that probably look like a miracle right now. So, who knows if the growth story's over here? The main highlight from the call was management explaining the situation in 4 points. Namely, 1. That Netflix growth is partially dependent on factors that they don't directly control, like broadband adoption, connected TVs, data costs, etc. So as those ebb and flow, so will their subscriber growth. And 2, of the 222 million households paying for Netflix, they suspect another 100 million are sharing passwords, which they decided isn't cool anymore. And 3, competition is picking up, primarily as they see traditional cable providers try to defend their losing share. And lastly, good old-fashioned macro vibes. So, while it's probably too early to tell if the growth story's over, the age of double-digit subscriber growth may have come to an end. Alright, so that's my quick take on the Netflix quarter. I hope you found it helpful, and if you did, please give it a like and hit the subscribe button for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.